Chapter 5 Focus, the long-run path of the wealth-to-income ratio. Part 1 of 5, the shape of the curve and the formula behind it.
Good evening.
Tonight's lecture is narrower than some of our previous sessions, and deliberately so. We are going to stay close to one specific question, the question at the heart of this part of Piketty's argument. How has the ratio of a country's total wealth to its total yearly income evolved over very long stretches of time, and what simple piece of arithmetic helps explain why it moves the way it does? I am going to use real published numbers tonight, drawn from the long-run historical data assembled for this kind of research, and wherever I use a number, I will tell you roughly where it comes from and why I trust it, so you can judge for yourself. Let's start with the shape of the curve itself, because it is genuinely one of the more striking pictures in modern economic history. For Britain and France, going back to 1700, researchers have reconstructed, using old census records, probate records, and national accounts, an estimate of national capital as a multiple of national income for every few decades across 3 centuries. Here is what that picture looks like. From 1700 until around 1910, in both Britain and France, this ratio sat remarkably steadily at around 7. Total national wealth equal to roughly 7 years of national income. Not creeping up, not creeping down, just sitting there, decade after decade, generation after generation, at roughly 7. Then, between 1910 and 1950, the ratio fell sharply. In Britain, it fell to around 2.5. In France, to a little under 3. In other words, in the space of about 40 years, the ratio lost more than half its value, after having been essentially flat for 200 years. And then, from 1950 onward, it began climbing again. By 2010, Britain was back to a little more than 5, and France to a little under 6. Not quite back to the old 7, but most of the way there, and the trajectory, at the time this research was published, was still pointed upward. Now, the United States tells a related but distinct story, and the differences are themselves informative. In America, going back to 1770, the ratio started lower, just above 3. It climbed to around 5 by 1910. It dipped slightly in the 1920s, recovered to between 5 and 5.5 by 1930, fell to below 4 by 1950, and was back to around 4.5 by 2010. Notice 2 things about the American pattern. First, the level is consistently lower than in Europe, roughly 4 versus roughly 7 across most of this history. Second, the DIP in the middle of the 20th century is much shallower in America than in Britain or France. America went from about 5 down to under 4, a modest decline. Britain and France went from about 7 down to around 2.5 to 3, a much steeper decline. Why these 2 differences? Let's take them one at a time, because each has a clear, well-documented explanation. Why was the American ratio consistently lower than the European one, across nearly the whole period? The main answer concerns land. In the colonial and early republic periods, the United States had an enormous amount of land relative to its population. Land was, in relative terms, cheap and abundant. In long-settled Europe, by contrast, land was scarce relative to population, and therefore commanded a much higher price relative to income. Since land was historically a large component of national wealth, a continent with abundant cheap land naturally has a lower wealth-to-income ratio than a continent with scarce expensive land, even if both economies are, in other respects, similarly developed. Why was the American dip in the middle of the 20th century so much shallower than the European one? The answer here concerns the physical and financial destruction of the 2 world wars. Continental Europe was a primary battlefield in both conflicts. Factories, housing, infrastructure, and transport networks were destroyed on a massive scale, particularly in France and Germany. Britain, while not invaded, suffered very heavy bombing damage to its cities and lost a large share of its overseas financial assets, the foreign investments that had been built up over the 19th century, partly through being sold off to help finance the war effort. The United States, fighting both wars primarily on other continents, suffered essentially none of this domestic physical destruction, and in fact emerged from both wars as a net creditor, with its capital stock intact and its relative economic position strengthened. This brings us to the formula I promised you, the piece of arithmetic that helps explain not just these specific numbers, but the general logic of why a wealth-to-income ratio settles where it does, over the long run, once a society is not being disrupted by something as dramatic as a world war. The formula is written as beta equals S over G. Beta is our wealth-to-income ratio. S is the society's net saving rate, the share of national income that is saved and added to the capital stock each year after accounting for depreciation, for wear and tear on existing capital. And G is the growth rate of national income. The intuition is this. Every year, a society adds some amount of new wealth, equal to S times its income. At the same time, its income itself is growing at rate G. If you let this process run for a very long time, the wealth-to-income ratio settles at a stable, long-run value equal to S divided by G. Let's make this concrete with the kind of numbers that have actually been observed in rich countries in recent decades. Suppose a country has a net saving rate of around 10% of national income, a figure that is broadly representative of many rich countries over recent decades. Now consider two different growth scenarios. If the economy is growing at 3% a year, a rate that was common during periods of rapid post-war catch-up growth, then beta equals 10 divided by 3, which is a little over 3. A wealth-to-income ratio of around 3. But if the economy is growing at only 1.5% a year, a rate that has become more typical in many rich countries in recent decades, as population growth slows and productivity gains become harder to achieve, then beta equals 10 divided by 1.5, which is about 6.5. A wealth-to-income ratio more than double the previous scenario, even though the saving rate did not change at all. This is, I think, one of the most important and most underappreciated points in this entire line of research. A wealth-to-income ratio of 3 versus 6.5 is an enormous difference in how a society feels, in how important inherited wealth is relative to current earnings, in how housing and asset prices relate to wages. And yet the entire difference in this example comes from one change: the growth rate falling from 3% to 1.5%. The saving behavior of the society did not need to change at all for the wealth-to-income ratio to more than double. This is exactly the mechanism behind the post-war to present-day story we traced a moment ago. Saving rates in rich countries have not changed dramatically over the past half-century. What has changed dramatically is the growth rate, which was very high during the post-war catch-up decades and has slowed substantially since, particularly as population growth has slowed in country after country. Lower G, with S roughly unchanged, mechanically pushes beta upward, exactly as the formula predicts, and exactly as the data we looked at a moment ago shows happening. I want to close this first part with an image that I think captures the formula well, and which I will be honest is my own way of picturing it, not something from the original research, but I find it helps. Imagine a bathtub. The tap represents saving, S, pouring new water, new wealth into the tub each year. The level the water needs to reach to keep pace with a growing tub represents G, because as the economy grows, the tub itself is getting bigger, and the water level relative to the size of the tub is what beta measures. If the tub is growing quickly, G is high, then even a steadily running tap struggles to raise the water level relative to the size of the tub, because the tub keeps getting bigger faster than the tap can fill it. But if the tub stops growing quickly, if G slows down, the same tap, running at the same rate, now fills the relatively smaller increases in tub size much more easily, and the water level, beta, rises toward the tap's own rate, S, divided by the tub's now slower growth rate, G. Keep this bathtub in your head. In part 2, we are going to look much more closely at what, exactly, this accumulating water is made of, because the composition of national wealth has changed dramatically over the period we have been discussing, and one particular type of asset, housing, turns out to be doing an enormous amount of the work in the recent rise of beta. See you in Part 2. Part 2, what is the wealth actually made of? The rise of housing.
Welcome back for part 2.
In Part 1, we trace the overall size of national wealth relative to national income, and we introduce the formula beta equals S over G to explain why that size changes over time. Tonight, we open the bathtub and ask what is actually inside it. What kind of wealth has been accumulating, and has the composition of national wealth changed, even when the formula for its overall size stays the same? Here is the headline finding, and I want to state it plainly before we unpack it, because it is one of the more surprising results in this whole body of research. Across almost every rich country studied, the long-run rise in the share of national income flowing to capital, rather than to labor, since around 1970, has been driven overwhelmingly by one specific asset class: housing. Not, as many people might intuitively guess, by shares in technology companies, or by industrial machinery, or by the tools and equipment that businesses use to produce goods and services. Housing. Let's think about why this might be, and let's use a very everyday example to build the intuition, before we go back to the aggregate numbers. Imagine a particular house in a particular city built in, say, 1960. The physical structure of that house, the bricks, the timber, the roof, the plumbing, has not fundamentally changed since it was built. If anything, after 60-plus years, parts of it have worn out and been replaced. In a narrow physical sense, the house itself has not become more valuable as a piece of construction. And yet, in many cities around the world, the market value of that same house, the price it would sell for today, is dramatically higher, not just in absolute terms, which you would expect simply from general inflation, but relative to INCOMES, relative to what an average local worker earns in a year. Where does this extra value come from, if not from the physical structure itself? It comes from the land underneath it, and more specifically from the fact that the location, the proximity to jobs, transport, amenities, has become more desirable, often because more people want to live in that city than there is housing available to accommodate them comfortably. This is the distinction that researchers in this area draw between what they call volume effects and price effects when explaining the rise in national wealth. A volume effect is what happens when a society builds more of something: more houses, more factories, more machines, more infrastructure. This is straightforward saving and investment, exactly the kind of accumulation our bathtub metaphor from Part 1 was describing. A price effect, by contrast, is what happens when the existing stock of an asset simply becomes worth more in relative terms without any new physical building or investment having occurred at all. The house is the same house. There are not more square meters of land than there were before, but the price of that same house, that same land, relative to incomes, has risen. The research finds that both effects have contributed to the rise in wealth-to-income ratios since 1970, but the price effect, particularly for housing and urban land, has been a remarkably large part of the story in many countries. In plain terms, a substantial part of the rise in national wealth, relative to income, over the past half-century, reflects existing homes and the land under them becoming more expensive relative to wages, not societies building dramatically more housing, relative to their populations, than before. Let's bring in a real-world comparison that I think makes this vivid. Think about the difference between two kinds of cities. In one kind of city, over the past few decades, the supply of new housing has grown roughly in line with the growth in population and demand. New apartment buildings, new housing developments on the edges of the city, have been permitted and built at a pace that has kept up with how many people want to live there. In such cities, house prices relative to local incomes have tended to rise only modestly, if at all, over long periods. In another kind of city, often one with significant geographic constraints, surrounded by water, by mountains, or by strict land use restrictions that limit how much new housing can be built, the supply of housing has grown much more slowly than the number of people who would like to live there. In such cities, the same underlying economic growth, the same rising incomes, translate not into more housing being built, but into existing housing becoming dramatically more expensive, because the limited supply is being bid up by ever more people competing for it. Several economists who have studied this pattern argue that geographic and regulatory constraints on housing supply are a major part of why the price effect on national wealth has been so large in certain countries and certain cities, rather than this being a uniform, inevitable feature of modern economies everywhere. I want to give you a concrete illustration using a real historical episode that connects directly to this housing story and that many of you will recognize: the lead up to the financial crisis of 2008. In the years before that crisis, in several countries, particularly the United States, Britain, Ireland, and Spain, house prices relative to incomes rose to levels that, viewed through the lens of national wealth to income ratios, pushed those ratios to historically elevated levels, in some cases approaching or exceeding the levels last seen before the First World War. When the crisis hit and house prices fell sharply in many of these countries, the national wealth-to-income ratio fell correspondingly, sharply, in the space of just 1 or 2 years, a much faster movement than the slow, multi-decade trends we discussed in Part 1. This is a vivid illustration of something important. While the long-run trend in beta is governed by the slow-moving S over G formula, in the short run, beta can be very volatile because it is heavily influenced by asset prices, particularly housing and stock market prices, which can rise and fall much more quickly than the underlying saving and growth rates of the economy. The bathtub from Part 1 fills slowly through the tap of saving, but the water level can also rise and fall quickly if the water itself, the value of existing assets, suddenly becomes denser or less dense, so to speak, through price changes that have nothing to do with how much new water has been poured in. Let's close Part 2 with one more piece of the composition story, something that I think is genuinely underappreciated: the role of a country's net position with the rest of the world. For most rich countries today, the value of assets that domestic residents own abroad, minus the value of domestic assets that foreigners own at home, what is called the net foreign asset position, is relatively small, typically within a range of roughly minus 10% to plus 10% of national income. In other words, for most large rich economies today, national wealth is overwhelmingly domestic wealth, not a story of vast overseas empires of assets. But this has not always been true, and Britain in particular offers a striking historical contrast. In the decades before the First World War, Britain had accumulated, through a century of overseas investment during the height of its colonial and commercial expansion, net foreign assets equal to a very large share of national income, by some estimates well over 100%, more than a full year's worth of national income held in assets located outside Britain itself, in railways, plantations, government bonds, and companies across the globe. Much of this overseas wealth was sold off, or lost, over the course of the two world wars, as Britain liquidated foreign holdings to pay for the war effort. This is part of why Britain's wealth-to-income ratio fell so sharply between 1910 and 1950. Not only domestic capital was destroyed or eroded, but a vast stock of overseas wealth, accumulated over the preceding century, was substantially run down within a few decades. So to summarize Part 2. First, the long-run rise in capital's share of income since 1970 has been driven overwhelmingly by housing, more specifically by rising land and property values relative to income, rather than by machinery, equipment, or business capital broadly. Second, economists distinguish volume effects, more saving and building, from price effects, existing assets becoming more valuable relative to income, and the price effect, especially for housing in supply-constrained cities, has been a large part of the recent rise in beta. Third, because beta is sensitive to asset prices, it can move much faster in the short run than the slow-moving S over G formula from Part 1 would suggest, as the 2008 financial crisis vividly demonstrated. Fourth, a country's net foreign asset position can be a major component of its national wealth, as Britain's enormous overseas holdings before 1914 and their subsequent decline illustrate. In Part 3, we are going to look at the other side of the national balance sheet that we have not yet discussed in depth: public wealth, the assets and debts of governments themselves, and how the balance between public and private wealth has shifted dramatically since the mid-20th century, with consequences that connect directly to debates happening in the news today. See you in Part 3. Part 3, The Other Side of the Ledger, Public Wealth and the Great Privatization.
Welcome back for part 3.
Everything we have discussed so far, the overall size of national wealth and what it is made of, has focused mainly on private wealth, the houses, savings, and financial assets owned by households. Tonight, we turn to the other side of a country's balance sheet, public wealth, the assets and debts of governments themselves, and a transformation in this area that has been just as dramatic as anything we have discussed so far, but receives far less everyday attention. Let's define our terms carefully because this matters. National wealth, the big number we have been discussing, is the sum of private wealth and public wealth. Public wealth is, in turn, the value of everything the government owns: public buildings, infrastructure, stakes in companies, financial reserves, minus everything the government owes, its accumulated debt. In the decades immediately after the Second World War, roughly from 1950 to 1980, public wealth in rich countries was, on average, positive and not trivially so. Across a range of developed economies, net public wealth, assets minus debts, represented somewhere between 15 and 25% of total national wealth. Governments in this period were significant net owners, not net debtors. This reflected both relatively low accumulated public debt, much of which had been reduced through a combination of growth and, in some cases, inflation in the post-war decades, and significant public ownership of assets, including, in several European countries, substantial stakes in banking, energy, telecommunications, and industrial companies that had been nationalized during or after the war. Now here is the transformation. Since around 1980, net public wealth has declined dramatically in most rich countries through two simultaneous channels. The first channel is privatization. Beginning in the 1980s and continuing for decades afterward, many of the state-owned companies and assets that governments had built up in earlier decades were sold, in whole or in part, to private investors. Telecommunications companies, airlines, energy utilities, banks, even, in some countries, water and rail systems, moved from public to private ownership. Each such sale, by definition, transferred an asset from the public side of the national balance sheet to the private side, even though the asset itself, the actual telephone network or power station, did not disappear or change in any physical sense. The second channel is the accumulation of public debt. Across many rich countries, government debt as a share of national income rose substantially from the 1980s onward, through a combination of fiscal deficits, the costs of financial crises, including the bailouts associated with the 2008 crisis, and more recently the costs associated with responding to the COVID-19 pandemic in the early 2020s. The combined effect of these two channels has been striking. In some major economies, net public wealth has not just shrunk, it has turned negative. In the United Kingdom, for example, one widely cited estimate shows net public wealth moving from around positive 60% of national income in 1970 to around negative 106% of national income by 2020. A swing of more than 160 percentage points of national income, from the government being a substantial net owner, to the government owing, in net terms, more than a full year of national income to its creditors. Similar patterns, though varying in degree, have appeared in the United States and several other rich countries, with net public wealth turning negative or close to zero in recent years. A small number of countries are notable exceptions, particularly resource-rich nations that have used revenues from natural resources, oil and gas in some cases, to build up large sovereign wealth funds, maintaining substantially positive net public wealth even as the broader trend elsewhere has gone the other way. Why does this matter, beyond being an interesting historical fact? Here is the connection I want to draw, and I think it is one of the more important practical implications of this whole body of research. If total national wealth, public plus private, has been roughly stable or even rising as a share of national income over recent decades, in the manner we discussed in parts 1 and 2, but public wealth within that total has fallen dramatically, even turning negative. Then private wealth must have risen by even more than the total figures alone would suggest, essentially absorbing both the overall rise and the public to private transfer. Put another way, a meaningful part of the growth in private wealth since 1980 has come not from new wealth being created from nothing, but from a shift, assets and value that used to sit on the public side of the ledger moving to the private side, through privatization, while at the same time governments have taken on debts that are, in effect, claims on future income, claims that will need to be serviced by future taxpayers. Let's connect this directly to a debate that comes up constantly in the news. The question of government fiscal capacity, the ability of governments to respond to crises, to invest in infrastructure, or to fund services without running into difficulty from accumulated debt. A government with substantial positive net wealth, as was common in the early post-war decades, has, in a sense, a cushion. It owns assets that could, if necessary, be drawn upon, and it carries relatively little debt that needs servicing. A government with negative net wealth, as is now the case in several major economies, has no such cushion in net terms. Every additional pound, dollar, or euro of spending that is not matched by revenue adds to a debt position that is already, in net terms, below zero. This is part of why, when large new spending commitments are proposed, whether for infrastructure, healthcare, defense, or responses to emergencies like pandemics or financial crises, the debate so often centers on where the money will come from, in a way that might have felt less urgent in net terms to a government sitting on a substantial positive net asset position in 1960. I want to give you a historical example that, I think, makes this transformation feel less abstract. Consider the case of a major national telecommunications provider, the kind of entity that in many countries was a single state-owned monopoly through the middle of the 20th century, providing telephone services to the entire population, often at regulated prices, and generating revenues that flowed in part to the state as owner. In the 1980s and 1990s, in country after country, such entities were privatized, sold to private shareholders, often through stock market floats that were, at the time, marketed heavily to ordinary citizens as an opportunity to become shareholders for the first time. The proceeds from these sales provided governments with one-off revenue, which could be used to reduce debt or fund spending in the short term. But from that point onward, the ongoing profits generated by that telecommunications company, profits that, under state ownership, would have flowed at least partly to the public purse, instead flowed to private shareholders. The state received a one-off payment in exchange for giving up an ongoing income stream that, if the company continued to be profitable for decades afterward, could well have been worth, in total, considerably more than the one-off sale price. Whether any individual privatization was, on balance, a good or bad decision depends on many factors specific to that case, including how efficiently the asset was run under public versus private ownership, and I am not making a blanket judgment here. But in aggregate, across many such transactions, over several decades, this is a significant part of the mechanism by which the public share of national wealth has fallen, while the private share has risen. So to summarize Part 3. First, national wealth is the sum of private and public wealth, and while private wealth has received most of the attention, public wealth has undergone an equally dramatic, but less discussed, transformation. Second, net public wealth was substantially positive, around 15 to 25% of national wealth, in most rich countries in the early post-war decades, but has declined sharply since 1980, turning negative in countries including the United Kingdom and the United States. Third, this decline reflects both the privatization of state-owned assets and the accumulation of public debt, two channels that both shift the balance from public toward private, or from public ownership toward public liabilities. Fourth, this transformation has real consequences for government fiscal capacity, helping explain why debates about funding new spending feel more constrained today than they might have in an era when governments held substantial net positive wealth. In Part 4, we are going to bring the beta equals S over G formula back into focus and look specifically at the decomposition researchers have done, breaking down exactly how much of the long-run change in wealth-to-income ratios is due to saving and investment, how much to the destruction and recovery associated with the world wars, and how much to changes in relative asset prices. This decomposition is, I think, one of the most genuinely illuminating pieces of this research, because it lets us put precise numbers on the relative importance of different historical forces, rather than just discussing them qualitatively. See you in Part 4. Part 4, taking the curve apart, saving war and prices.
Welcome back for Part 4.
In Part 1, we saw that the wealth-to-income ratio in France and Germany fell sharply between roughly 1914 and 1950, then climbed back toward its earlier level by 2010. Tonight, we ask a more precise question. Of that big fall and that big recovery, how much was due to each of the different forces we have touched on? The physical destruction of war, the level of saving, and changes in the relative prices of assets. Researchers working with these long-run series have actually attempted to decompose the fall in this way, separating it into distinct components, and the resulting breakdown is, I think, genuinely surprising if you have only heard the story told in broad strokes. For France and Germany, the two continental economies that were most directly fought over in both world wars, the physical destruction caused by the wars, bombed factories, destroyed housing, ruined infrastructure, accounts for roughly 1/4 of the total fall in the wealth-to-income ratio over this period. That leaves 3/4 of the fall to be explained by something else, and the remaining 3/4 splits roughly evenly between two further causes: low saving and negative valuation effects, meaning falls in the relative price of assets, including the loss of overseas portfolios we discussed in Part 2. In other words, of the entire collapse in wealth-to-income ratios across this catastrophic period, only about 1/4 is directly attributable to bombs and physical destruction in the narrow sense. The other 3/4 reflects decades of low net saving, economies plowing relatively little of their income back into new capital, often because of the disruption and uncertainty of the period, and falling asset prices, including the policies introduced after the First World War that were explicitly designed to restrain the power of capital, rent controls, capital controls, and the high taxation we have touched on in earlier lectures. This is a genuinely important corrective to a popular but oversimplified version of this story, the version that says, in effect, the wars destroyed Europe's capital, and that is why the ratio fell. The wars mattered, and physical destruction was real and significant, accounting for roughly 1/4 of the effect. But the larger part of the story is about what happened in the decades surrounding the wars, low investment, and a sustained period in which the relative prices of capital assets fell, partly as a direct consequence of deliberate policy choices. And here is the mirror image for the recovery since 1950. The research finds that the recovery has been driven importantly by the reversal of these same forces. From the 1980s onward, many of the policies that had restrained capital values in the interwar and immediate post-war period, capital controls, certain forms of regulation on asset markets, were gradually lifted. This contributed to what is sometimes described as an asset price recovery, rising relative prices for housing and financial assets, on top of the steady accumulation from ongoing saving and investment that the S over G formula from Part 1 describes. Let's make this concrete with a real-world example that I think captures the asset price recovery vividly. Consider the stock market. In the decades immediately following the Second World War, stock ownership in many countries was, by later standards, a relatively marginal activity, confined to a fairly narrow segment of the population, and stock market values, relative to the overall size of national economies, were modest. From the 1980s onward, in country after country, stock market capitalization relative to national income rose substantially, reflecting both genuine growth in corporate profitability and a broader RE rating of financial assets, a willingness of markets to value the same stream of future profits more highly than had been the case in earlier decades. A useful, if slightly playful, way to think about this. Imagine a piece of farmland that produces the same crop, year after year, with the same yield. In one era, buyers might be willing to pay, say, 15 times the annual crop value for that land. In a later era, for the same land producing the same crop, buyers might be willing to pay 25 times the annual value. The land has not become more productive, but its price, relative to what it produces, has risen because the relationship between asset prices and the income streams they represent, what economists sometimes capture in valuation ratios, has shifted. Something quite similar happened with housing and equities across many rich economies in the decades after 1980. I want to bring in one more current, real-world thread here, because it connects this historical decomposition directly to a debate happening right now. The question of why growth rates have slowed in rich countries, the G in our formula, and what that implies going forward. Demographically, the picture is fairly clear and well documented. Population growth rates in most rich countries have slowed dramatically compared to the mid-20th century, and in a number of countries, population is now projected to be roughly flat, or even declining, over coming decades, as fertility rates have fallen below the level needed to maintain a stable population without immigration. Since overall economic growth can be thought of, in a simplified way, as the sum of population growth and productivity growth per person, slower population growth mechanically pulls overall growth down, even if productivity growth per person were to remain completely unchanged. And if, in addition, productivity growth per person has also slowed, for reasons that are themselves debated, perhaps because the most transformative technologies of the 20th century, electricity, the internal combustion engine, modern sanitation, have already been broadly diffused, and newer technologies, while important, may not match that scale of transformation, then both components of G have moved in the same direction, down. Recall the bathtub from part 1. If G falls and S stays roughly the same, beta rises. This is, in a real sense, the demographic and technological backdrop against which the asset price recovery and the broader rise in wealth-to-income ratios since 1980 has been playing out. Not a single cause, but several forces: slowing population growth, slowing productivity growth, the reversal of mid-century anti-capital policies, and ongoing saving, all pushing in a similar direction at the same time. So to summarize part 4. First, of the dramatic fall in wealth-to-income ratios in France and Germany between 1914 and 1950, only about a quarter is directly attributable to physical destruction from the world wars. Second, the remaining 3/4 splits roughly evenly between low net saving during this turbulent period and negative valuation effects, falling relative asset prices, partly the result of deliberate anti-capital policies introduced after the First World War. Third, the recovery since 1950 reflects, in part, the reversal of these valuation effects, an asset price recovery as earlier restrictive policies were lifted from the 1980s onward, visible clearly in the rising relative value of stock markets and housing. Fourth, this recovery has occurred against a backdrop of slowing population and productivity growth in rich countries, which independently pushes the wealth-to-income ratio upward, through the S over G relationship from part 1. In our final part tonight, part 5, we are going to step back and ask what all of this means looking forward, not backward. If beta has been rising, and if the demographic and policy trends behind that rise show few signs of reversing, what does the research itself say about where this might be heading? And what are the genuine, open uncertainties, the things even careful researchers in this area are honest about not knowing for certain? See you in part 5. Part 5, looking forward, what the long-run data does and does not tell us.
Welcome to our final part tonight.
We have covered a great deal of ground, all of it focused tightly on one question. How has the ratio of wealth to income evolved over 3 centuries, and why? We have the shape of the curve, roughly 7 for 200 years, a collapse to 2.5 or 3 by mid-century, and a partial recovery toward 5 or 6 by 2010. We have the formula, beta equals S over G. We have the composition, dominated increasingly by housing. We have the public side of the ledger and its dramatic decline since 1980. And we have the decomposition, separating the roles of war damage, saving, and asset prices. Tonight, briefly, let's look forward and let's be honest about the limits of what this kind of analysis can tell us. The first thing to say is that the S over G formula, beta equals S over G, is a description of a long-run steady state, the value the ratio would settle toward, eventually, if saving and growth rates stayed at given levels indefinitely. Real economies are never in a steady state. Saving rates and growth rates both fluctuate, sometimes substantially from decade to decade, and external shocks, wars, pandemics, financial crises, technological revolutions, can shift either variable abruptly. So when the formula suggests that, with a saving rate of around 10% and a growth rate of around 1.5%, beta might tend towards something like 6 or 7, this is not a prediction that beta will reach exactly that number by some specific date. It is closer to a statement about the direction things are pointing, given current saving and growth patterns, and a reminder of what kind of wealth-to-income ratio would be consistent with those patterns if they persisted. The second thing to say concerns a genuine, open empirical question. Will growth rates in rich countries continue to slow, stabilize, or could they rise again? On one side, the demographic trends we discussed, slowing or reversing population growth in many rich countries, are reasonably predictable for at least the next few decades, since the people who will be of working age in 2040 have, for the most part, already been born. This component of the slowdown in G has a fairly high degree of certainty attached to it. On the other side, productivity growth, how much more output an economy can produce per worker per hour, is far less predictable. Productivity growth depends on innovation, on the diffusion of new technologies through the economy, and on countless factors that have, historically, proven very difficult to forecast even a decade in advance, let alone several decades. Some researchers and commentators argue that current developments in fields such as artificial intelligence and automation could meaningfully raise productivity growth in coming decades, which, if it happened, would tend to push G up, and all else equal, push beta down, partially offsetting the demographic effect. Others are more skeptical, pointing to previous episodes of technological optimism that did not translate into the productivity gains that were anticipated at the time. This is, genuinely, an open question, and I think it would be dishonest to present it as settled in either direction. The third thing to say concerns the public wealth story from Part 3 and its own forward-looking uncertainty. Net public wealth has declined sharply, and in some countries turned negative over the past 4 decades. Whether this trend continues, stabilizes, or reverses depends heavily on policy choices about taxation, about public spending, and about whether governments, going forward, run the kinds of deficits that have characterized much of the period since 1980, or instead move toward running surpluses that would gradually rebuild positive net public wealth. Unlike the demographic component of G, this is not something that can be projected forward mechanically from past trends. It depends on decisions that have not yet been made, by governments and electorates that have not yet decided how they will respond to the fiscal pressures, including those associated with aging populations, that lie ahead. Let me close with a final, real-world example that I think ties several threads from tonight together, and which is unfolding, in various forms, in countries around the world right now. Many rich countries are currently grappling with the question of how to fund retirement income and healthcare for aging populations, at a time when, as we discussed, net public wealth is low or negative in several of these countries, meaning there is little in the way of a public asset cushion to draw upon, and when slower population growth means there are relatively fewer working-age people, relative to retirees, than in previous decades. At the very same time, private wealth, as we discussed across parts 1 and 2, has risen substantially relative to income in many of these same countries, driven significantly by rising housing values. A large share of this private wealth is held by older generations, who, in many cases, purchased housing decades ago at prices that, relative to incomes at the time, were considerably lower than today's prices relative to today's incomes. This creates a situation where a society can simultaneously have, on one hand, a government with limited net resources to fund the costs of an aging population, and on the other hand, a private sector holding historically high levels of wealth, much of it concentrated among older age groups and tied up in housing. How societies navigate the relationship between these two facts, whether through taxation, through changes to how retirement and care are funded, through housing policy, or through some combination of approaches, is one of the central economic and political questions many countries are actively working through, right now, in real time. It is not a hypothetical future scenario. It is the subject of ongoing political debate in country after country, as I speak to you tonight. And that, I think, is the right note to end on. Not a prediction and not a verdict, but a recognition that the long-run patterns we have spent this evening tracing, the rise and fall of beta, the shift from physical to housing-dominated wealth, the decline of public wealth, are not simply historical curiosities. They form the backdrop, the often invisible arithmetic, against which very current, very live debates about taxation, retirement, housing, and the role of government are actually taking place. Understanding the arithmetic does not, by itself, tell you what to do about any of this. But it does mean that when you encounter these debates, in the news, in political campaigns, in conversations with people in your own life, you will be able to see the shape of the underlying curve, the bathtub filling and emptying over centuries, sitting quietly beneath the surface of the argument.